If in doubt, do nothing. The Bank of England has decided to keep the cost of borrowing on hold. The Monetary Policy Committee voting 8-1 to maintain bank rate where it is at 4.5%. Now, the nudges and winks in the minutes suggest that the next move will be down, but they don't offer any guidance really on when. We still think that interest rates are on a gradually declining path, says the Governor, Andrew Bailey. We'll be looking very closely at how the global and domestic economies are evolving at each of our 6 weekly rate-setting meetings. Now, in one sense, very little has changed since the Bank of England last convened last month. The British economy continues to crawl along in much the same way that the bank predicted. Prices in January did rise by a little more than the bank had forecast, but not in a way that changes the narrative. It remains the bank's view that annual inflation will peak at 3.75% at some point in the autumn before falling back towards target. As far as the employment market is concerned, the number of people on company payrolls has been broadly stable since last May. Pay is rising faster than prices, but too fast for the Bank of England's liking. So why not cut? Well, there are broadly 3 concerns. The first is that companies face a very big rise in their employment costs next month when the changes the Chancellor announced in the budget last October take effect. National insurance contributions will rise because the rate is going up and the threshold above which national insurance is paid is going down. And the bank will want to see more evidence about what that means and how companies adjust their behaviour. The concern is, of course, that it could stoke inflation. The bank's agents are reporting that firms are telling them that they plan to already seek to offset their costs by raising prices, as well as awarding lower pay rises, cutting hours, and in some cases letting people go. Now, the degree to which companies do each of these things will decide how the bank feels in the months to come about cutting interest rates. The second big concern is the conflicts in Ukraine and Gaza. The way these progress, the way they play out, have the potential also to affect global energy prices, the price of gas, the price of oil, which, as we found out in recent years, can have a very profound effect on the cost of living here in the United Kingdom. The third great unknown is, of course, President Trump. He's been in power for 10 weeks. He's created absolute havoc. His trade policy, little unclear, but certainly the threat, the imposition, the rescinding of tariffs, the postponement of tariffs, the potential escalation of tariffs. Goodness, who knows what's going to happen next. But we know that tariffs have the potential to affect growth, and also inflation to a various degree. Global trade policy uncertainty has intensified, notes the Minutes, and the United States has made a range of tariff announcements to which some governments have already responded. How big a risk to the British economy do tariffs and the threat of tariffs, which is very real, pose? The bank doesn't really offer a view. It chooses not to. Behind the scenes, though, in the building behind me, they will be furiously running the numbers. The market view, for what it's worth, is that we will get 2 further interest rate cuts this year. Probably one in May, probably one just before Christmas. And the bank isn't really leaning into that view. It seems happy to run with it for now. But frankly, who knows what will happen next? If in doubt, sit on your hands.
Well, we have seen consumer confidence decline, even though when you look at wage growth, it remains relatively strong. And we are expecting inflation eventually to ease relatively quickly this time around and not to peak where it was before. So in terms of purchasing power, consumers should be continuing to recovering their purchasing power. So that is good news. Problem is, on the other side, is that interest rates will probably continue falling at a slightly slower rate. So for those mortgage holders, it may be a little bit more costly for them than what they may have hoped just a few months earlier.
And in terms of the different factors that play into these types of decisions, can you talk us through that process when it comes to the MPC? How much might have elements like tariffs played into it versus our own economic situation?
Yeah, absolutely. So one of the things to bear in mind from the start is that there is a lot of uncertainty. So it's much harder for the MPC members to make up their mind because no one really knows what is going to happen, and the deviation could be relatively high. But just looking at what we know at the moment, there's a number of factors they need to bear in mind. The first is that we're likely to see weaker growth. Weaker growth would, all else being equal, means that inflation is likely to be slightly lower. So that would allow them to cut rates more quickly. But then at the same time, you've got tariffs. Tariffs on themselves, just imposed on export, should not be inflationary. On the contrary, they could be deflationary. But if we retaliate, that could be inflationary because it means that our imports will be more expensive. So it's really a mixed picture at the moment, and it's hard for them to say what will be the end goal. The other thing that is very important to bear in mind is public sector spending. We've heard that there's a very large package of additional spending in Europe. That would mean that potentially there'll be also more demand for products in the UK around defense and technology, and that will make the economy here a little bit hotter as well, with some potential upward implications for inflation here too.
As you say, so many different factors to take in when it comes to these decisions. Was there any split on the MPC on the latest decision? Does that give us any clues on potential concerns they might have in the future?
Yeah, absolutely. So the vast majority, 8 versus 1, agreed to hold, with 1 opting to cut by a quarter. I think generally it shows relatively still dovish bias. The monetary policy is still relatively restrictive, and therefore we should expect further cuts in interest rates, although there may be fewer than what we were hoping for earlier.
And looking ahead, we have a huge moment for the Chancellor, Rachel Reeves, next week with her spring statement. The key word, growth, as we heard during the election campaign. Will anything we heard today from the Bank of England's governor on that topic give her pause for thought before that big event?
So the real event that will potentially accelerate growth in the UK is a industrial strategy, which we will probably hear in June. I'm not sure whether there is any significant announcement we should expect in the spring statement that will propel growth significantly. It may dispel a little bit of the domestic uncertainties, but overall, we're not expecting any major driver of growth from that statement.
And how would you sum up the Bank of England's view on growth for the next year, 2 years, for example?
I think the Bank of England is, as many other economists, is concerned about the uncertainty and is likely to be more cautious. In the longer run, there's potential upsides from technology, not just AI, but other technologies. There's upside from additional spending on defense, but infrastructure more broadly, and R&D. Short term, we see relatively negative sentiment. We see relative cautious private sector investment, and that could put downward pressure on growth.
A lot to think about and a lot to look out for in the future. Yael Selfine, Chief Economist at KPMG UK. Thank you so much.
Thank you.